And we meet again for another important FOMC day. Markets are all but decided that we're going to get a 25 basis point rate hike, but there's so much more to play for here, and Bitcoin could be at risk of a major rugging. We're gonna have to check in here into the Bitcoin price action, guys, because we've got a really important FOMC announcement coming up in 8 minutes. If you're excited for this one, smash up the likes. Make sure you're subscribed if you're not, guys. Those of you waiting in the waiting room so patiently, thank you so much for waiting. Excited to have all of you guys in here. I was saying in the Telegram earlier, I wasn't sure if I wanted to jump on and do a live stream, because when we were doing these FOMC live streams, nobody was doing these 2 years ago, right? Nobody thought that macroeconomics mattered for crypto. Crypto was in the bull market and everything was green, and everybody's like, oh, what are you looking at the Dixie for? What are you looking at interest rates for? And we've been doing that for 2 years now. And it's pretty much become a joke now where even the Moon Boys are covering FOMC, even though they don't really know what it means. But thank you guys for being here. Appreciate you guys. Let's get straight into it. Look, markets are expecting 25 basis points, right? There's no surprise here. You know, broad consensus here that we're going to get it. But we got to tune into the press conference. We're going to get the rate hike decision in 7 minutes time. Then we're going to move on to the press conference where we have to understand, are we going to get another rate hike? That's the bit that the market cares about. Because the market, as it's poised right now, and we've been speaking about this over the last week or so, is saying, okay, he's going to do one more, but then he's going to pause in September, right? And you can see here 77%. Now it's starting to creep here. Look at this. The 21% of the market is starting to pricing in, which is why we're seeing a bit of red. They're starting to price in the possibility that we could get another one, which takes us to 5.5 to 5.75. Remember in the June dot plot, I know this gets a bit complicated, but it's where all the FOMC officials came in and they voted, the consensus of them voted that the terminal rate will be 5.75. So 2 rate hikes will take us to the upper bound being 5.75. So that's when the market's starting to think, hang on, maybe it's not just one more, maybe we get another one in September. And then that's going to push the can down the road, right? Because then after that, we don't get another meeting until November. So pretty much the rest of the year is hiking then. So that's what the market is relying on today. And I'm expecting the markets to put quite a bit of weighting on what happens here. So I've got the split view open. As you guys know, if you've been here for a while, on the right-hand side, we'll have the NASDAQ to see how the traditional markets move. On the left-hand side, we'll kick off with Bitcoin. And you can see here the 5-minute chart here on Bitcoin, getting a bit of a rally here in towards the announcement here. 6 minutes to go before the announcement. Just while we're doing that, let me just make sure that you guys can hear the television okay. Give me a shout if you can hear this.
And inflation has turned the corner, then that's when I think the Fed may start to talk and actually cut interest rates. So I do think in early 2024, we back.
Right, let me know if that worked in the comments, guys, so then we can switch over to it when we need to. Now, very quickly here, guys, let's jump into the Bitcoin price action here, because I need to show you guys what I've been speaking about. On the weekend, I made a video saying that Jerome Powell could be set to rug us. And straight after that video, you've seen that this week has just started pulling us down. Look at this week, horrible 2.5% week. And I warned of that, because I said, guys, we could be pulling back into our EMA ribbon here. So I made it very clear that DCAing for me around 27.7 would be a beautiful buy here at the EMA ribbon. That doesn't mean we can afford to lose the EMA ribbon. We can come into here, that's okay. Another way for me to show this to you guys is this diagram. And I'm really rushing because I want to make sure we get to the announcement. But it's this bit here. Let me just show you this. It's this red box that I want to show you. Okay, this red box here, I'll show you in the daily chart because it looks a little bit cleaner. You've got a very important channel, and it's at this bottom of the channel, and I said this before we started rotating up here, that I'm looking for DCAs. I'll start nibbling already. These are already nice prices when we touch 29.1. They're decent prices, but I'm looking for more of a pullback into here. Now, what's the positive situation? We have to cover off the positive situation, even though it's very unlikely, is Jerome Powell comes out and pauses. Unlikely that case, right? If he does, this is going to go to the moon. We're going to have good fun and we can break through 31 and the things could look quite positive. But more realistically, if for the positive scenario, even though I don't think he's going to do this either, is that he will do his 25 basis points, but maybe what he can do is just kind of give us confirmation that we're nearly there or we're making progress. I don't think he's going to do that. I don't think he wants to mess up right now. He does not want financial conditions to loosen. There's nothing for him to gain. Right? The economy is not weak. Unemployment is not high. He doesn't need the market to rally. He needs to avoid inflation from bouncing back. That's his only fear right now. He's nearly there. He can see the finishing line. He just needs to finish it off. He does not want this market rallying. And this market already wants to rally. You're seeing the NASDAQ rallying anyway, right? And of course, Bitcoin being much further than we are. Quick, I wanted to cover off the risk as well, guys. And the risk is that if we come into this DCA area, and I will be DCAing in here, the risk is what happens if we fall out, right? If we fall out, your first price target is 24,000, 24.8. Then you've got, and it sounds horrible, the 20,000 mark, right? And really getting down to 19,500 right here when we started that rally. Those are the price targets. Let me show this another way. This is also a head and shoulders pattern. Look at that. Yeah, that's a head and shoulders pattern. How do you measure the price move of a head and shoulders pattern? You take that move, and we're going to apply it to the point of breakout. Excuse me for doing this very crudely, guys, but you can do this more accurately on your own devices. And again, brings you to that 19,500 range, 19,200, okay? So we need to watch out. Falling down into this channel is okay, but losing it is not. Now, I don't think personally that we're going to head down here. When we were at 19,500, we didn't have as much progress being made on inflation. We made a lot of progress between now and then, okay? We've made a lot of progress. I'm going to switch over now to the TV. Hopefully that gives you guys a good update. You know what to expect. Please do smash up the likes, guys. 2 minutes until the announcement. Can every single one of you guys smash up the likes? There's a bunch of you in here. You've just not hit the likes. Come on, guys. Hit the likes for me. You can always undo it if this deteriorates. Let's switch over to Bloomberg, and I'll get the interest rate decision up in the next minute or so.
Prints down the road on the 10th in August, on the 13th in September. Is that enough information then to make a change at the back end of September?
I think by then, the year over year will make it evident that they'll have to acknowledge that inflation has improved.
TK, that's the runway into the September meeting.
The runway into September, and I'd go beyond that to November and December as well. We were talking about this months ago. We're trying to get out 2 and 3 meetings on this. Most important thing I heard in this half hour of discussion is Mr. Michael talking about, hey, folks, forget about the parlor game. You know how much I hate it. There's this balance sheet dynamic as well, allowing for further restriction.
Huge dump there on Bitcoin, guys. Look at that. Bitcoin falling here on the 5-minute chart for those of you trading. Again, for those of you trading, be very, very careful out there, guys, okay? Do be very, very careful. For those of you looking for DCA opportunities, if we do get a pullback, that's personally what I'm doing because I don't have the time to trade when I'm live streaming. But I will be looking for DCA. You can support the channel, ijaz.uk/buybit.
Bit gun shy to call one thing or another and to have conviction. For them to come out and say, yes, inflation has eased substantially, means that they could be setting up for another transitory moment at a time where you've gasoline starting to rear back up and you have housing markets that are continuing to bottom.
All right, guys, I'm going to start refreshing now. We've got about 30 so seconds left. I want to be one of the first to get it. I've got 2 devices here. I always have a backup device because sometimes it freezes because so many people want to access this website at the exact same time. Quite impressive from them, actually. Audio is clipping for me like it's too loud. We'll check that in a second, guys. Let's just get this let's get this interest rate decision. Let's find out what are we getting here. Remember, markets are looking for that increase to 5.25, which is 5.25 to 5.5. Here we go. It's open. Let's get it. Let's get it. Let's get it. They decided to raise. There you go. 5.25 to 5.5. 25 basis points as expected. Let's see how markets are responding here, guys. Let's see how markets are responding and markets are moving, okay? Because markets are moving a little bit here positively. It's just traders taking out their position. Just let it cool out for a bit. We want to see what happens here. But we have got our 25 basis points as expected. No prizes for guessing that, right? Everybody was expecting that. Let's keep the TV here as well so we can watch it even if we're not listening to it. And yeah, let's see where this settles down, because I think the reality for markets here, and we've got Bitcoin on the left-hand side here, just kind of oscillating. We've got the NASDAQ really starting to pump here, with traders just kind of trying to exit positions, etc. But we need to now see what the press conference says, right? Like I said in the preamble to this, it's all about if we're going to get 2 rate hikes. The market already expected 1. That wasn't the surprise. The surprise is Jerome Powell and the team going to go for more? Remember, it wasn't a completely unanimous decision to pause at the last meeting. And so, and that's why now we need to kind of get a gauge from Jerome Powell. How hawkish do they sit as a group? Not just him. As a group, how hawkish does it sit? Do they still want to do multiple rate hikes this year? And was that just a one-off pause? Or are we getting clues? Like, give us a clue, brother. But I don't think he's going to give us a clue. I think he's going to come out quite firmly and continue to be the normal Jerome Powell, because the job's not done and he doesn't want to risk the job being undone, right? It's not worth it for him. All right, let's see what Bloomberg's saying. Let's see what the suits are saying.
Chairman Powell's got to speak in about 28 minutes' time, the news conference coming up. That statement, a bit of a snooze. So let's check out the price action off the back of it. It's 1. Are they done? That was your rate hike from the Federal Reserve. Your equity market just a little bit softer still, trying to recover. We're down by about 0.2% on the S&P 500. On the NASDAQ, we're negative by 0.4%. The fate of the NASDAQ, of course, through the next week in the hands of earnings from Meta, Apple, Amazon over the next 7 or 8.
Early signs here, and again, like I said, it's just traders, but the NASDAQ's got more impetus there. Look at how the NASDAQ's moving to Bitcoin on the left-hand side. Like, Bitcoin's just not moving as much, a bit more of a stable coin action here. compared to the Nasdaq. Definitely more impetus in the Nasdaq at the moment.
Of that, with yields just about unchanged, the dollar showing just a touch of weakness against the euro in response to this decision. Euro dollar at about 110.74. TK, a rate hike from the Federal Reserve. It's about the what's next. It always was.
22 years out, you go back, I believe the math is to 2001. Joining us, Diane Swank, Chief Economist, KPMG. Bob Michael continuing with us with JP Morgan. Diane, I'm going to just argue this, and I did this 2 days ago in a YouTube short showing the NASDAQ 100 decline of March of 2001. Things unraveled the last time we were at interest rates of this level. Do we have an analog here to the collapse of the market in March of 2001? Can a Fed policy affect a present stock market collapse?
Well, it certainly can if they go far enough, and so far it's been remarkably resilient. I would argue that we're also seeing this against the backdrop of what looks to be a bubble emerging in Gen AI, which is a little reminiscent of 2001, but not quite there. But I think that's important to remember as well. I think the larger issue for the Fed at this point in time is that financial conditions are fighting them a bit, and even though they've got additional quantitative tightening, they've continued that. That's why they're still going forward. And I would argue one step further in that the good news we've gotten on inflation recently further emboldens the Fed to actually get to that 2% target. There was sort of this sense.
So just to fill everybody in layman's terms about where we're at right now. So Jerome Powell's remit is to bring inflation down to 2%. Right? And he started on his journey with inflation crazy levels high, and he started increasing interest rates, tightening financial conditions, and he started making great progress. And as a Fed official, you've got to balance the two remits. He's got to balance the labor market, and he's got to balance and bring inflation, price stability down, right? He's got to bring inflation down to his 2% target. Now, what started happening was he started seeing inflation coming down, but the labor market was remaining remarkably resilient. So that emboldened him to then say, you know what, I can finish this off. Because remember, we spoke about this months and months and months ago. You don't want to do what Paul Volcker did at the time, which is where you did aggressive rate hike, but then you had entrenched inflation where it was like stuck at 5-6% for a very long time thereafter, and US couldn't get rid of it. That's not what Jerome Powell wants. He doesn't want to stop at 4% and US live with 4% inflation for many, many years. That's not okay. He's got to get it down to that 2% target level. So he's going to continue. But the problem he has is at the same time, the financial markets are saying, hang on a second, inflation is coming down. They see the data, we all see the data, and they start rallying. So you've seen the S&P and you've seen the Nasdaq start to rally. But the problem that then has a knock-on effect on inflation again. So Jerome Powell has to keep the markets tight. He has to keep them in the box. And that's why these methods he has of jawboning and speaking aggressively to the market is what's going to be important, because he's got to keep them in the box until he's finished his job. But the powerful thing is going to be two things. There's two really important things which people aren't talking about right now. And the first is about banking. If you remember when we had Silicon Valley Bank collapse, and this is a big thing that's on my mind right now, those banks, those regional banks were in turmoil a couple of rate hikes ago, at least, right? If you go back however many months it was when they started collapsing, we've had a couple of rate hikes since then, right? At least two. So if they were struggling then, they're going to be struggling even more now. If they have to write off the face value of their bonds then, and they were illiquid, they were insolvent, what are they going to be now? So I've got this worrying feeling in my head that there are more regional banks and companies, by the way, out there that are struggling, that are just trying to hang on, and they could just be, this 25 base points or the next one, if there is another one at the next meeting, could be the straw that breaks the camel's back, could be the one that pushes them over the edge. Right? So this is something we have to think about. And you'd hope that Jerome Powell has that data and he's using that data, because the argument is going to be, it really could just be one more 25 base point rate hike than he needed to, with a lag effect, because remember, these effects have a lag effect, that could then drive the economy into recession. So he's doing a great job, but there's a risk that while he's doing such a great job, he could just do one too many rate hikes, get too trigger happy. We start seeing some banks collapse. We start seeing some companies struggling. We start seeing mass layoffs, and we trigger ourselves into a recession with stagflation. Could be, right? So he's got to thread this needle very, very carefully here, Jerome Powell. Markets are just stabilizing here. Nothing much, guys. And again, and nobody was expecting anything here. It was priced in. Remember, if it's priced in, you get no points for it. That's always, it doesn't matter that you're right. The whole market was right. There's nothing here that's concerning anybody, okay? We expected 25 base points. Now we need to talk about this bit. Does he align himself to what the market's expecting? Because 77% of the market is expecting expecting a pause. 21% is expecting another 25 base point rate hike in September. Give us clues around this. Are we doing a good job? Are we doing a bad job? Are you getting closer to pausing? Are you not? This is what we need to hear from Jerome Powell at the press conference in the next short while. Any questions, guys? Feel free to pop it in the chat and we can cover it off. But I do want to kind of finish off my thoughts here on Bitcoin, because this is the main asset we need to be looking at right now. A lot of people are talking about altcoins. I'll make videos about altcoins as well. That's fine. But the reality is Bitcoin always has to set the pace. Until we can get out of this bear market and enter our raging bull market, which already we've made a lot of progress in. We've gone from 19,500 to sitting quite comfortably here at 29 for now. We've got to take credit for that, right? We are in a better position than we were just here at 19,500, right? But the question is going to be, can we now set ourselves up for the next move? And what I'm looking at mainly is the weekly time frame. And on the weekly time frame, you guys know that when we moved this first leg up, we ran all the way up here to the peak of 30,968. We just missed shy of 31K. And we came all the way back down. And if I bring up the EMA ribbon, you can see we came nice into our EMA ribbon. And we covered this. We covered this perfectly. We bought the dip here, and everything moved nicely here, right? And we collected that dip, and then beautiful 2 weeks here, getting us straight back here. And then this week here on this candle, we managed to get a higher high. We ran to 31,845. So we did wick to a higher high, which is fantastic compared to that peak. So we do have higher highs. Now we need to accompany that with a higher low. The low of this candle fell to 24,825. So my absolute dead stop is that level. Now, of course, I don't want to go to 24,800, but my absolute dead stop here is we have to rotate before where my cursor is at 24,800, right? Because that's the low of that candle. Okay, that will keep our higher highs and higher lows. We're not in a raging bull market. We'll be holding onto it by the skin of our teeth, but it still would be an upward trend. Now, ideally, we can just come into this box, right? Ideally, we just come into the box which I shared with you, and it's enough to bounce from here and bounce with vengeance. How beautiful would that be? Boom, touch there, boom, off we go. Nice DCA, and we start working to the top side. That would be fantastic. And in doing so, what would we have done? We would have played out our nice cup and handle pattern as well, right? That would be fantastic. If we can do that, if we can come back down here, EMA ribbon, boom, 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 and work our way up, good, we'll take that, right? But what we don't want is a prolonged pullback down, falling out of this wedge. We can't afford to be falling out of this channel here, okay? So where that red box is for me to be DCAing, I'm okay in there. I can't afford to be losing this weekly EMA ribbon. That's not good, right? We just about held on to it when we came to touch our EMA ribbon here, and we managed to have a strong end to the week to pull us back in. We can't afford to be losing it this time, okay? We need to keep our upward trend above our EMA ribbon and continue to ride above it. So that's where we stand on Bitcoin. I will come on to your questions, guys. Make sure you keep popping your questions in the chat. I will come on to those. The other thing we need to speak about is this dollar index, right? I don't like the strength that I'm seeing on dollar index, but it's still in a bearish pattern. There's still hope for us to do what I'm saying here, which is to send it to the downside. Reject it here from the bottom. That would just be a retest, right? Where it does this, boom, and then throw it back to the downside. That's fine. But the last 2 weeks here on the dollar index have been strong. It bounced from its 200 exponential moving average line there, and it's moving upwards. It's going to want to run into its EMA ribbon. But if it does, we're going to get pain on Bitcoin. If it spends a couple of weeks going into there, we're going to have a couple of weeks of pain on Bitcoin, right? And that's what's going to get us to our EMA ribbon at the same time. So while Bitcoin's coming down into its EMA ribbon, dollar index could be moving up into its EMA ribbon. But the key is what happens thereafter. Because if the dollar index reclaims it and goes up here and does this and boom, 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 Bitcoin's in trouble to the downside, right? So very important. If this wants to move into the EMA ribbon, fine, but we need to send it back thereafter. Bitcoin equally needs to bounce from its EMA ribbon and go break above 31K. Go create another higher high, right? Because then the challenge will be set. You can't just bounce from your EMA ribbon and not set a higher high. So there's a lot to play for. All right, let's see what you guys are saying in the chat, my lovely people. How are you feeling about this crypto market? You guys must be frustrated. It's been a painful, boring market. But look, ultimately, this is where you DCA, right? I know it's difficult. And again, we've been through these cycles before. All that's going to happen when this market pumps is you guys are going to say, I wish I bought more. So take these opportunities, take these red days, take them, be grateful for them, because nobody has ever said when the bull market's raging and you're back at 69,000 on Bitcoin, all you're going to be telling me in the chat is, I wish I bought more. I wanted to pull back. I wish I bought more. Is it ever going to go back to 30 ever again? I don't know. So if it's at 29,000 and you think this is good value for Bitcoin, and you even remotely think it's going to get back to 69,000, then ask yourself, what are you doing? Right? And in the same vein, you're worried about altcoins. I see so much whining going on about certain altcoins, when it's like all prices of altcoins are irrelevant right now. You either believe in the altcoin or you don't. I don't care about the price, right? Whether it's whatever number you're quoting on the chart, it's irrelevant. They're all 90% down. If you genuinely believe in that altcoin and you think it's going to do well in the next bull market, you just add it to your portfolio, don't you? You put your money where your mouth is and you hold it. If you don't, it doesn't matter. It doesn't matter. Let's see what you guys are saying. Going to 27.5, pump to 36. Interesting. Yeah, that matches with what we're saying here. Bounce on the EMA ribbon. Shoaib says, even if Powell manages to pull a soft landing, Phantom is dead and the next Harmony 2.0. Ultimate Chicken, Ijaz, why is he not pausing sooner? Wouldn't holding the rate being inflation down enough? We're near the 3% mark. This is something he doesn't want to risk, right? If he pauses and just holds it there, he's not sure that that's enough. He wants to strike while the iron is hot. He doesn't want to look back and say, I had an opportunity in at half year on 2023 to really finish inflation off and get us from the 4s and the 3s down to the 2%. And I didn't take it. And now the US for many years are stuck and he's the laughing stock, right? When he could have finished it off. But equally, I'm with you. I understand that, one of these rate hikes could be the one that breaks the economy. So he's got to tread very, very carefully. And ultimately, it's not just him who makes a decision. They do it together and they vote, right? And there's no real easy answer, even though we give him stick. Cowabunga says the right move now, I think, would be to relay to the market that this was the last hike for the foreseeable future. He needs to open a hole in the head to relieve pressure. Yeah, I think, look, ultimately, we have to remember that Jerome Powell's more data than us. I'm with you, right? I'm worried, like I just ranted about there, that stuff is going on in the background. Like, the last we heard of these regional banks, they were collapsing left, right, center. And suddenly, you've been increasing rates more, and you're telling me that nobody's struggling. What have you done in the background, right? So I'm hoping that Jerome Powell has access to their data, can see who's in trouble, and he's probably done the calculus, you hope. Well, who knows, this is the USA, remember? Hopefully he's done the calculus to say doing one more 25 base points is not going to kill them off. If it does, what a nightmare, right? Then he would have been better off pausing. But obviously he's got to make that decision with the data he's got. Let's see what else you guys are saying. Krypton Guy, little dump, be nice right now to stock up on the altcoins before going in September. I think so. I think this, the argument here is that the bears will always tell you that this is going to collapse back down to 10,000, back down to 15,000, and whatever other number they want to shout out that's really low, right? But when you look at this is an upward trend, right? If you invested here and you're sat here, have you not done well? So I don't know what people are whinging about, right? The whingers are the ones that are in, they're out, they take it all about, they just don't know what they're doing. They're playing around in the market, and every YouTube video or Twitter post from somebody messes with their emotions. Ultimately, if you're buying and you're holding, you're up nicely here. So coming up in a pullback to here is you crying over this, right? Did you cry here? Maybe you did. Did you cry here? You shouldn't cry here either, right? Because after each one of these legs, look at that, little call off, boom, boom, call off, boom. It's fine. It's part of an upward trend. Now, that is very different to us losing our EMA ribbon, right? If we lose our EMA ribbon, that's different. So if we fall below these levels and then you're a little bit worried, that's granted, right? We don't want to be losing structure in the chart. No, we don't. But where we're at right now is just the negative leg to an upward trend, which is part of the process. And as investors, we need to be able to time the purchases so we buy at the lows, right? If we look at it from this chart perspective, let's take it from this chart, you just want to make sure that over time, more often than not, you're buying at the bottom of the channel. I don't want you to be that person that every time is buying at the peak of the channel. If you're buying here, you're in pain right now, right? If you're buying here, you're fine. If you're nibbling here, you're fine. If you're nibbling here, you're fine. If you're nibbling now and buying heavier when we get lower, you'll be fine as well. Because what's the next thing that's going to happen? Hopefully we bounce, we go back up, we'll come back down. It's part of investing. It's part of the game, guys. You've got to learn to take the ups and the downs. Scott Collins, what level would you buy Injective? I don't currently have an opinion on Injective in terms of the TA, but we can do some analysis on it at some point, perhaps. Darren, name your top 3 alts. Ooh, that's a difficult one. I mean, obviously Ethereum, but that's cheating. I like Matic. And then I think I would have said Phantom before the multi-chain hack, interestingly. I would have said Phantom. So I'm a bit trumped on my third one. I don't have a third favorite. I have a bunch that I can list there, like Optimism. I like Chainlink still. I still like Cardano. A lot of people sleeping on Cardano. I don't know why. I feel like they're going to do well long term. Those are my kinds of plays. A bit outdated, but they're the kinds of play I like. I know a lot of people are excited by some of the more newer, exciting plays. But I like to keep it old school. Just like to top up on some of the bigger projects, the ones that have been there, seen it, done it. And there's this other narrative that goes around like, oh guys, you need to sell all your positions of any coins you held in the last cycle because, and I know who's propagating this. There's certain channels that are, spreading this. They just want you to wreck your portfolios for their own incentives. But, there's no evidence behind every single project that's been in the last bull run not running in this bull run. There's no evidence behind that, right? That doesn't make any sense. XRP, Cardano, Matic, DOT, all still around and doing well. Right? Where did this evidence come from? Yes, there are new and exciting projects all the time. And you should look for them and you should, when you like them, add them to your portfolio. But to get rid of ones from the last cycle, how does that make any sense? They're the ones that are tried and tested. For me, those are the ones, if they've proven themselves in the US's fastest rate cycle we've ever seen, why would I dump those? Right? They're battle tested. They're stress tested. Why would I dump those to add an Aptos or a Sui who are yet to prove anything, or a WorldCoin, which if you haven't watched my video, by the way, go check that out as well. Yeah, WorldCoin. Don't fall for that scam, guys. Please don't scan your bloody iris. Don't do it. Let's see what you guys are saying here. We've done that one. Ian says 100%. Omar says, what is the next buy zone for Phantom? I mean, without looking at the technicals, you just want to get in now, right? Like now is peak FUD. If you look at it from a fundamental perspective, this is peak FUD. And now you're getting down to the levels here of June. But what's interesting is there's so much FUD on Phantom, which we've covered off at length, that it's still not even got down to this wick. The price it went down to in June, the lowest was 21 cents. We've not hit 21 cents on Phantom, despite the whole multi-chain attack, which is very, very interesting. It shows a lot of resilience because the hatred on Phantom has been huge. And I think some of that has been completely founded and some of that has been unfounded. I think if this was another project and a bridge got attacked, I'm not going to name projects, but ones which are VC backed, right? You would not be getting the same. You would not be getting the same uproar. The reason you're getting this uproar is the exact reason I initially invested in Phantom, was because they didn't have the VC. They didn't have the VC energy behind them, which is why I liked it 2 years ago, right? I added it. I was like, oh, this is an interesting project. Undervalued. Doesn't have the crazy multiple that others did, like Solana and other VC-backed projects, and add it. Doesn't mean that the team didn't make mistakes. I confronted him in our Mike Kong interview. Made a lot of mistakes, and hopefully they learn from them, right? And it will be a reputational damage, and who knows if they're going to recover from it. But it's a risk you've got to take, and that's what crypto is. Crypto is not about every pick you have getting it right. If you think that's what it is, you're completely getting it wrong. Investing, whether that's VC investing, whether that's startup investing or private equity, you do a couple of investments and a certain percentage of those are going to turn out well. Some of them you'll break even. Some of them you might take some loss on it. And that's part of investing, right? Same for trading. You're not going to get every trade right. That's not the point of the game. But if you don't stand for anything, if you don't have any conviction, if you don't put anything on the line, then how are you going to gain, right? If any time there's a little bit of FUD and you get shaken out, you're just that person who's giving your money to exchanges in trading fees. That's all you're doing, right? Because you're in and you're out, you're in and you're out, you're in and then you're not, you're hot and you're cold, right? It doesn't work. Have conviction. And if that conviction changes, you change. Simple. If they break one of your red lines, your fundamental, they did something which you don't agree with, you're out, right? I'll tell you how I feel about Phantom. If that outage was a Phantom tech outage, it'd be a different scenario. It'd be a different scenario how I'd address that, right? And I'd probably be on this channel saying, guys, I don't care what the price action is doing, even if it's pumping, I'm out. Because I don't like the fact that the tech is breaking or that they did something fundamentally wrong or they did something shady. But for me, it's the bridge. Now, of course, that came with a bunch of mistakes from their side that they could have mitigated, but it's a slight difference. You need to understand that nuance. XRP Falcon, I picked some Phantom up this morning. Ian says, I'm not sure that Phantom can recover for this bull run. It's going to be an interesting one for them. It's not going to be easy. I mean, it wasn't easy for them even without that. So with that, it's even more harder. But maybe it sparks them. Maybe it does what they needed. Because if anything, what was one of our complaints, guys? We kept coming on this channel and we kept saying, that there's just not enough going on, right? There's no impetus. They're not kind of, they're just kind of resting on their laurels. Where's the marketing? Where's the updates? Where's, so let's not pretend that Phantom were doing swimmingly before this. No, they weren't. They had their challenges and we've got to call out those challenges, just like we do for every other project. Just like I would do for Solana, even though I hold Solana. Just like I do for Cardano, even though I hold Cardano. Just like I would do for Algorand, even though I hold a little bit of Algorand. I will call them out if they're not doing the right things, right? And the marketing aspects and the updates and the lack of biz dev was a problem and continued to be a problem. The tech was amazing, right? The tech was amazing, but who cares, right? For me, that's the minimum requirement to do business, is have good tech. And even then, how long is your tech going to be relevant for? If you're resting on the laurels of your tech, and this is now 2, 3, 4 year outdated tech, the new blockchain, guess what they're going to spin up with? Better tech. But you need to then build your community and build your marketing and build your use cases and build your relationships with dApps and build your trust level, right? Otherwise, you're no different to a new entrant who's going to come in with better tech than you because they're using the latest tech. XRP Falcon says the truest thing I've heard today, which is smash the likes, guys. Guys, you've not even got me to 100 likes. You're violating me. You're absolutely violating my life off. Ultimate Chicken, we will always be correlated to NASDAQ and traditional markets, or do you think it will be a decoupling is part of the bull run? We will get a decouple. We will get a decouple, but I think as crypto matures more and more, you will see us become more correlated to the markets. And I think you will have moments related to the Bitcoin halving and the bull run where we decouple for a bit, like we did periodically a little while ago. Then I think they'll reconcile and get correlated again. And I think that's how it's going to go, right? The only true time crypto will decouple is when we get the hyper Bitcoinization, right? That kind of situation where the dollar collapses and Bitcoin's the new currency and fiat's in the bin. Like then, of course, you're going to get your decoupling. But until then, it's gonna be treated as a risk-on asset, and more so that the traditional markets get in, the more so that a spot ETF gets approved, BlackRock are in the game. It's gonna move more and more in tandem with the Nasdaq for sure. That correlation will only increase. Dave was hoping for a 0.5 basis point rate hike so I can buy the dip. Yeah, we were never likely to get that. It's more that they tell us today that they're definitely going to do another one. If they do that, like say something like, I don't know, if they say, the pause is done, now we're going to get back to business or something like that. That basically means that was just a one-off, the pause, and now they're going to get back to doing 25 basis points. So we want to listen for language like that. Always correct. Any micro caps you have your eyes on, bro? Depends what you're defining as micro cap. I don't go too low nowadays, guys, especially not in a bear market. I'm not going anything less than kind of 600-700 million, so I'm probably not your guy for those small micro caps. In a bull market, yeah, of course we can have a play around with those, but right now I need stronger projects in my portfolio. I can't be having these weaklings that can't hack the difficulty. Doug says US House is holding vote on crypto. By the way, guys, we do get the press conference in 6 minutes. 6 minutes, we'll get the press conference. Let me just pop that up here for you guys. There you go. And you should see that somewhere. Check me out. Technologically advanced. Ian says 0 chance they're getting these eyes. Views on BlackRock covered that. Max says, Slams, thanks for sharing your knowledge. You're always welcome, buddy. That's what this channel's about. That just about me sharing my knowledge. You guys will do your research. I'll do my research. Only difference is I'm sharing it on a camera, right? Nothing special. I've got a mic, got a camera, sharing my research with you. If it's useful, great. If it's not, add it to your repertoire of other research that you're doing and come to conclusions, right? That's what this is all about. It's just us sharing knowledge. Omar says, to all Phantom holders, it could be worse. I hold Coty. Yeah, Coty, like, I still take Phantom over Coty right now, 100%. I've shared my feelings on Coty as well in the past, and the whole Coty community attacked me. Very, very nice of them. Taylor Mitchell, wow, haven't checked Coty in a while. That's insane. Yeah, what's it doing? Has it gone? Yeah, Coty is really struggling. And look, when I confronted the community, that's what I don't like. The one thing I like about Phantom, and is that they do admit when they're making mistakes, right? Like, for example, Michael, he apologized on the interview, and I don't even mean this time. I even mean the time when I interviewed him last year as well. They know that their marketing's not right. They know that there's certain bits they have to work on. They've not got enough use cases. They've not got games being built, NFTs being built. Whereas Coty, I mean, the whole community want to attack you on this, which is insane, absolutely insane. I did reach out to the CTO of Algorand. Didn't fancy jumping on, maybe not, but he told me to reach out to comms, so I don't know. I'll maybe email their comms team, see if they want to jump on. Yeah. If you have anybody else, any other projects that want to jump on, just get them to follow me on Twitter. We can always DM Lefty, how do you feel about the gaming narrative still? Still relevant, or is it an older cycle? Definitely an older cycle. My view has always been that gaming and NFTs is like the thing that will move at the ends of the bull market. At the final innings of the bull market, you'll see gaming and NFTs pop off. So if you're buying now, really, you really have a long-term thesis on it, in which case you're just buying and holding. But then there's a huge risk, because for every 10 games, maybe one will win. And therefore, hopefully you're spreading your bets across a couple, by holding one. Super challenging for sure. Digital D says your research on WorldCoin was superb. Definitely a dystopian nightmare world avoiding. Just say no to orbs. Absolutely, I think that's horrific. And I think what makes it worse is it's being pushed by one of the clearly new elites, the new world elite, Sam Altman, who's obviously created OpenAI. Just ludicrous. I just don't understand it. Make sure you go watch my video if you haven't watched it. I broke down exactly what this WorldCoin is, how they want to scan your irises, and the other crit. This was getting crazy. It's getting crazy, guys. Just make your money and keep things moving. Tufel, are you still holding your Phantom? Absolutely. You should know me better than that. I'm not a seller. I'm holding my Phantom. They'd have to fundamentally break my trust, in terms of real fundamentals, right? For me to sell. If a bridge breaking for me is not enough for me to be selling a project. I want to see how they figure it out. If they don't learn from their mistakes, that's a reason. I don't want to be invested in a project that doesn't improve and learn from its mistakes. I don't mind being in a project that makes mistakes. That's okay. But you can't go away from core values like lying, lack of truth, lack of focus, pivoting their idea. If tomorrow they come out and say, oh, we're pivoting our idea completely to we're going to become a gaming platform. What are you on about? Right? These kind of things, that's where I'm not interested. Max K, Astar, no opinions on Astar right now. For me, getting involved, Polkadot's got enough work to do itself, right? So as a rule of thumb, if you're holding like what I call second derivative plays, which are ecosystem plays, so like, anything in the Phantom ecosystem or anything in the in the Polkadot ecosystem, I wouldn't want to be holding those right now. Not now, when we're not fully in a bull market just yet. Those things, you'll see them move. For now, it's not even sure that things like, the base layers are going to run, let alone getting into those ecosystem plays. But I know some of you are DGen, you want your higher returns, in which case just be wary that you could lose, right? That's the risk you're taking. Omar, will I add more Phantom? Not yet. Not looking to add more Phantom. Like I said, we're not even at June lows yet. So why am I desperate to add? It's not like crazy juicy prices or anything. They made a mistake. I'm waiting to see how they react from it. Waiting to see the update. Waiting to see, do they get these funds back? At the moment, I'm assuming these funds will never come back. But that can change, right? But there's no reason for me to be diving in. It's not like some crazy price point now I want to be topping up loads. No. Sunu says, with a surname like Altman and now releasing an altcoin, and the press conference should be up soon, guys. Here, let's just switch over to the TV. Nope, he's not on yet. I will definitely switch over to him, guys, as I see him waddling across to the podium. Yassine, if you had 3K, how much would you put in HBAR and Cadena? I've done a video on that, so search a channel. I've covered off both HBAR and Cadena. But the first thing I would do is, if I had 3Ks, I make sure at least 1.5 of that is in my vegetables, in Bitcoin and Ethereum. Right, Jerome Powell, live. Let's go to press conference, get yourself something to drink, and it will be boring.
Squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting, and as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path, as it will be consistent with the CPI reading, but we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture, and starting with we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance. Including in particular in the labor market. We'll be looking at inflation. We'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. Monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here. We're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter, and that by September that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below-trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything, and we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data. And that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris. Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now, after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you were really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Go to Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down. The point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think that's, I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
So we shouldn't assume that every other meeting is the lowest tightening frequency, let's say. It could be, longer intervals in between as well.
I think we're going to look. I think we're going to make a decision about the next meeting, and then we're going to make a decision about the one after that. And I think it'll sort itself out.
Thanks. Howard Schneider with Reuters. Among your colleagues, there have been people who've said they feel that very little transmission has taken place so far from monetary policy into the economy, and there are those who feel, they say, it's happened very fast this time and it's kind of up to date. Where are you on that continuum?
So there's a long-running debate about the lags between changes in financial conditions and the response to those changes from economic activity and inflation, right? So we know that in the modern era, financial conditions move in anticipation of our decisions, and that has clearly been the case in this cycle. So in a sense, the clock starts earlier than it used to, but that doesn't necessarily change the process from that point on, and it's not clear that it has. I'll tell you what we know and then what we don't know. We know that financial conditions affect economic activity and inflation with a lag that can be long and variable, or lags, plural, that can be long and variable. A lot of uncertainty around the length of the lags, and by the way, that's just one component of the broader uncertainty that we face. So I'll tell you how I think about this. The first thing to say is we're determined to bring inflation down to 2% over time, and we will use our tools to do that. No one should doubt that. I would look at it this way, though. The real federal funds rate is now in meaningfully positive territory. If you take the nominal federal funds rate, subtract a mainstream estimate of near-term inflation expectations, you get a real federal funds rate that is well above most estimates of the longer-term neutral rate. So I would say monetary policy is restrictive, more so after today's decision, meaning that it is putting downward pressure on economic activity and inflation. We'll keep monetary policy restrictive until we think it's not appropriate to do so. So that's how I think about it. I mean, if I sum it up, I would say we've come a long way. We are resolutely committed to returning inflation to our 2% goal over time. Inflation has repeatedly proved stronger than we and other forecasters have expected. And at some point that may change. We have to be ready to follow the data, and given how far we've come, we can afford to be a little patient as well as resolute as we let this unfold.
On the credit side, I'm wondering if you saw anything in the latest SLOOS data that made you think you're getting a quantum of credit contraction beyond what you'd expect. The bank lending data really is, the growth rates edging down towards and heading below zero, which is usually a recession indicator.
So I guess the SLOOS will come out early next week, and I would just say it's broadly consistent with what you would expect. You've got lending conditions tight and getting a little tighter. You've got weak demand, and it gives a picture of pretty tight credit conditions in the economy. I think it's really hard to tease out how much of that is from this source or that source, but I think what matters is the overall picture is of tight and tightening lending conditions, and that's what this SLOOS will say.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. Could you break down the reasons why inflation has fallen and what share of that credit you would give to factors that don't stem directly from rate hikes or that might be within your control at all, like easing supply chains and a drop in energy prices over the past year?
Yeah. So, interesting question. So, let me start by saying that the inflation surge that we saw in the pandemic resulted from a collision of elevated demand and constrained supply both of which followed from the unprecedented features of the pandemic and the response from fiscal and monetary policy. And we've always expected that the disinflationary process would stem from both from the normalization of those broad pandemic-related supply and demand conditions and from restrictive monetary policy, which would help return the balance between supply and demand by restraining demand. And we think that's broadly what we're seeing. So to go break it down a little further, of course, headline inflation has come down sharply from elevated levels as energy and food prices have come down, mostly due to reversal of the effects from the war in Ukraine. And that's a good thing, and the public experiences that, as I mentioned earlier. For core inflation, I'd say there has been a role for both factors, both that I mentioned. Clearly, for goods, normalization of supply conditions is playing an important role, as is the beginning of the reversal of spending back into services and away from goods. Take autos as an example. The combination of an increase in sales and inventories, while vehicle inflation has decelerated, points to a substantial role for supply. But there's also a role for demand, as the loans and things like that are more expensive. So they're both working there. Housing services inflation now starts to move down. Clearly, higher rates have slowed the housing market. I would say monetary policy is working about as we expect, and we think it'll play an important role going forward, in particular in non-housing services, where really we think that's where the labor market will come in as a very, very important factor. So we think both of those sources of disinflation are playing an important role.
I see. And just to follow up, do you think that of those two sources, that core will rely more heavily on seeing an impact from rate hikes, or is there a more even split there too?
I think monetary policy is going to be important going forward, because we're sort of reaping now the benefits of the reversal of some of the very specific pandemic things. We're seeing that with goods in particular, with supply chains and shortages moving, and we're seeing. So I think going forward, monetary policy will be important, particularly in the sector, in the non-housing services sector.
Edward. Thank you, Chair Powell. First, let me compliment your tie, the choice of tie. So thanks for taking our question. So the Beige Book, it said, input cost pressures remain elevated for services firms, but eased notably for manufacturing sector. Is that an indication that there's a wage inflation pressure? And how do you target and pressure on the wage inflation without pushing the economy into recession?
Well, I think as it relates to goods, it's really an indication that supply chains and shortages are easing. And so what was the first part of it?
So wage inflation, like how do you target wage inflation without pushing an economy into a recession?
I don't think we're targeting wage inflation. I think what we're looking for is a broad cooling in labor market conditions, and that's what we're seeing. So wages have actually been gradually moving down. They're still at levels that would be consistent over a long period of time with 2% inflation. Nonetheless, we're making progress there. And by so many indicators, labor market demand is cooling. You can look at surveys by workers and businesses who see that. You can look at the quits rate normalizing. You can look at job openings coming down. You can look at just job creation in the establishment survey it's still at a high level, but it was at really an extraordinarily high level for most of the last 2 years. So you see cooling, particularly in private sector, in the last in the last report. So I think we see that, and it's happening at a gradual pace. So that's actually not a bad thing in a sense, because if what we see is a labor market, very strong demand for labor, which is really the engine of the economy. People are getting hired, many people going back to work, getting wages, spending money, and that's really what's driving the economy. But that it's gradually slowing, it's gradually cooling. That's a good prescription for getting where we want to get.
But still, we see a push to raise minimum wage. We're seeing a lot of unions go on strike or threaten strike, and the common thing is they come out with agreements like big pay increases, like UPS, and we have the auto workers coming up. Are you concerned then about a trend of series of big unions, these contract pushing wage inflation then?
Not for us to comment on contract negotiations. Not our job, not our role. We monitor these things and we'll keep an eye on them. But really, that's something that's handled at that level. And
there's a large amount.
Victoria. Hi, Victoria Guido with Politico. I wanted to ask about the SEP, which suggests that you would cut rates as overall and core PCE get to around or under 3%. And so I'm wondering, is the level of inflation what's sort of important there as you think about getting to 2% and when you might start cutting rates? Or is the speed at which inflation is falling also important?
I think you'd take both into account. I think you'd take everything into account when you start cutting rates. It would depend on a wide range of things. And when people are writing down rate cuts next year, it just is a sense that inflation is coming down and we're comfortable that it's coming down and it's time to start cutting rates. I think, but I mean, there's a lot of uncertainty between what happens, in the next meeting cycle, let alone the next year, let alone the year after that. So it's hard to say exactly what happens there, what's motivating people.
So if it's sort of stubbornly in maybe the high twos, you wouldn't necessarily cut rates.
I'm not saying that at all. I'm not giving you any numerical guidance around that. I'm saying we'd be comfortable cutting rates when we're comfortable cutting rates, and that won't be this year, I don't think. It would be, many people wrote down rate cuts for next year. I think the median was several for next year. And that's just going to be a judgment that we have to make then, a full year from now. And it'll be about how confident we are that inflation is, in fact, coming down to our 2% goal.
A good part of Wall Street has become more confident that the Fed is going to be able to engineer a soft landing, and they've reduced their forecast for a recession. And I'm wondering if the staff has changed its view on the likelihood of a recession being likely, and if you personally have changed your view in terms of becoming more confident that you can achieve a soft landing.
So it has been my view consistently that we do have a shot, and my base case is that we will be able to achieve inflation moving back down to our target without the kind of really significant downturn that results in high levels of job losses that we've seen in some past instances, many past instances of tightening that look like ours. That's been my view. That's still my view. And I think that's sort of consistent with what I see today. So, but it's a long way from assured, and we have a lot left to go to see that happen. So the staff now has a noticeable slowdown in growth starting later this year in the forecast. But given the resilience of the economy recently, they are no longer forecasting a recession. I just want to note that that our staff produces its own forecast, which is independent of the forecast that we, as FOMC participants, produce. Having an independent staff forecast, as well as the individual participant forecast, is really a strength of our process. There's just a lot of, I think, constructive diversity of opinion that helps us informs our deliberations, helps us make, I hope, better decisions.
And is the reason for optimism that inflation has come down and you still have a strong labor market? I mean, does that add to the optimism?
I wouldn't use the term optimism about this yet. I would say, though, that there's a pathway. And yes, that's a good way to think about it. We've seen so far the beginnings of disinflation without any real costs in the labor market, and that's a really good thing. I would just also say the historical record suggests that there's very likely to be some softening in labor market conditions. And consistent with having a soft landing, you would have some softening in labor market conditions, and that's still likely as we go forward with this process. But it's a good thing to date that we haven't really seen that. We've seen softening through not through unemployment, not through higher unemployment. We've seen softening through job openings coming down part of the way back to more normal levels. The quits rate, so people are not quitting as much. We've seen participation, people coming in, and so labor supply has improved, which has lowered the temperature in the labor market, which was quite overheated, going back a year or so. So we're seeing that kind of cooling, and that's very healthy, and we hope it continues.
Thank you, Mr. Chairman. Jeff Cox from CNBC.com. You and other Fed officials in the past have suggested that you don't need to keep hiking until inflation hits 2%, that as long as you see continued progress. So I'm wondering, how close do you need to get with the inflation numbers coming down? How many months of data do you need to see that will give you sufficient confidence? And how far does this fight need to go before you're willing to kind of declare victory on it?
So the idea that we would keep hiking until inflation gets to 2%, it would be a prescription of going way past the target. That's clearly not the appropriate way to think about it. So, in effect, if you look at our forecasts, the median participant, and again, these are forecasting out years, so take them with a grain of salt, but people are cutting rates next year because the federal funds rate is at a restrictive level now. So if we see inflation coming down credibly, sustainably, then we don't need to be at a restrictive level anymore. We can move back to a neutral level, and then below a neutral level at a certain point. I think we of course would be very careful about that. We'd really want to be sure that inflation is coming down in a sustainable level. And it's hard to make. I'm not going to try to make a numerical assessment of when and where that would be, but that's the way I would think about it. Is you'd stop raising long before you got to 2% inflation, and you'd start cutting before you got to 2% inflation too, because we don't see ourselves getting to 2% inflation until all the way back to 2 until 2025 or so. So.
Jennifer. Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. It's been over 4 months since a handful of regional banks, including Silicon Valley Bank, failed. When you look at credit conditions now, given Banc of California's acquisition of PacWest, does this acquisition suggest the full impact has not been felt, or are you comfortable saying that we've seen most of the ripple effects that may have occurred at this point, and how does this play into your outlook for policy?
So I don't want to comment on any particular merger proposal, but I will say things have settled down for sure out there. Deposit flows have stabilized. Capital and liquidity remain strong. Aggregate bank lending was stable quarter over quarter and is up significantly year over year. Banking sector profits generally are coming in strong this quarter, and overall the banking system remains strong and resilient. Of course, we're still watching the situation carefully and monitoring conditions in the banking sector. In terms of the actual effect on, if you think of a particular set of banks that were affected because of their size and business model and things like that were more affected by the turmoil in March than others, it's very hard, as I mentioned, it's very hard to sort of tease out the effects on this very large economy of ours from them tightening. They may be tightening a little bit more, probably are, than other banks. The SLOOS has been telling us for more than a year that banking conditions are tightening. That process is ongoing, and that will restrain economic growth. So I think we have to take a step back from. I can't separate those anymore. I think basically we're just looking at the overall picture, which is one of tightening credit conditions, and that's going to restrain economic activity. It is restraining economic activity. So that's how I would look at it.
And how is that informing your outlook for setting policy?
So I think that is an expected result of tightening interest rate policy is that bank lending conditions would tighten as well. And so the question is it more effective this time because of what happened in May? I just don't think we know that. I think we're looking at the current data in GDP, and we're seeing strong spending. We're seeing a strong economy, and it's made us confident that we can go ahead and raise interest rates now for the third time since the March events. It seems like the economy is weathering this well, but of course we're watching it carefully and expect to continue to do that.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I wondered on wages if you were at all concerned about any inflationary impact of wages now outpacing inflation, which is likely contributing to the boost in consumer sentiment and the continued strength of the consumer that we've been seeing.
Well, wages in excess of inflation means real wages are positive. Again, that's a great thing. course, we want that. We want people to have real wages, but we want wages to be going up at a level that's consistent with 2% inflation over time. As I mentioned, nominal wages have been coming down gradually, and that's what we want to see. We expect to see more of that. That's just more of what's consistent over a longer period of time. We don't really think that wages were an important cause of inflation in the first year or so of the outbreak, but I would say that wages are probably an important issue going forward. Labor market conditions broadly are going to be an important part of getting inflation back down, and that's why we think we need some further softening in labor market conditions.
This goes sort of to the balance of risks question, but you mentioned at the start how you're keeping an eye on consumer activity and whether there might be some sort of a rebound there. And I'm curious what the Fed's explanation would be to families if further interest rate hikes start to hit the labor market, start to drive that sentiment back down. What's the message there of why you continue to keep rates elevated or to raise them?
Well, we have a job assigned to us by Congress to get inflation under control. And we think the single most important thing we can do to benefit those very families, especially families at the lower end of the income spectrum, is to get inflation sustainably under control and restore price stability. We think that is the most important thing we can do now, and we're determined to do that. And I would just point out that the people who are the most hurt by inflation right away are people who are on a low fixed income, who, when you're talking about travel or transportation costs, heating costs, clothing, food, things like that, those, if you're just making it through each month on your paycheck and prices go up, you're in trouble right away. Even middle class people have some resources and can absorb inflation. People in the lower end of the income spectrum have a harder time doing that. So we need to get this done, and the record is clear that if we take too long or if we don't succeed, that the pain will only be greater. So that's how I would explain what we're doing.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You had said last month that this meeting this week was going to be a live one. In the event the market had assigned a roughly 99% probability to the rate move that you announced today, the decision was, of course, unanimous, and the statement was basically unchanged from last month. So may I ask, to what extent was the meeting actually a live one? Was there ever any doubt over the past 2 days about what the decision was actually going to be?
Well, was there doubt? I would say there's a range of views on the committee, and when you see the minutes in 3 weeks, you'll see that. There's a range of views about what we should do at this meeting and what we should do at the next meeting, and it's a process that we go through. Many times when we go into a meeting, the decision is not, fundamentally in doubt. Nonetheless, we have the meeting, and some meetings are less uncertain than others, and I'll just leave it at that.
Evan Reiser, Market News International. Thank you, Chair Powell. Financial conditions have been loosening at a fairly steady clip in recent weeks, the dollar, the stock market, et cetera. What does that mean for the Fed in being sure that inflation will come down to target?
So we monitor, of course, financial conditions, broad financial conditions. You're right, it's the dollar and equities, and we're of course very focused on rates and our own policy. We're going to use our policy tools to working through financial conditions to get inflation under control. The implication is, we will do what it takes to get inflation down, and in principle, that could mean that if financial conditions get looser, we have to do more. But what tends to happen, though, is financial conditions get in and out of alignment with what we're doing, and ultimately, over time, we get where we need to go.
If I could also ask about the SEP from June that showed rate cuts. Do you expect the Fed to cut nominal rates next year while also continuing QT?
So that could happen. The question is, is that consistent with? So if you think about both of them as normalization, imagine it's a world where things are okay, and it's time to bring rates down from what are restrictive levels to more normal levels. Normalization in the case of the balance sheet would be to reduce QT. So to continue it, you depending on where you are in the cycle. So they're two independent things, and really the active tool of monetary policy is rates. But you can imagine circumstances in which it would be appropriate to have them working in what might be seen to be just different ways, but that wouldn't be the case.
Go to Kyle.
Thanks, Chair Powell.
Up there doesn't look like we're going to be getting much more. Ultimately, seems like a nothing burger, right? So it is. He did come out hawkish. We do have the 25 base point rate hike. I will be posting a separate short TLDR for those who didn't manage to catch all of that. But as you can see, this is why if you're trading the FOMC, you can trade it, but don't add to your long bags, right? Don't add to your long bags during FOMC. Nice volatility to trade, always a very similar pattern, right? You guys can trade this. If you're not doing anything else, you're looking for a way to make a bit more side income, you can trade these moves, right? Very predictable. You can see the movements as they happen. You know when to get out. This is trading, right? You can trade these momentum. People do it all day long. It's just traders bidding the price up, selling, go back down, right? We're exactly where we were when we started. Exactly where we were when we started. I will do the update and I will post that up shortly. So make sure you go watch that if you didn't manage to catch everything. Thank you for joining me for another FOMC Live. And I'll see you in